Welcome. Thank you for attending our webinar. The topic of our webinar is retirement income planning, how to maximize your Social Security benefits. We're also going to talk a little bit, Jesse's going to talk a little bit about at the end about Medicare and signing up for Medicare. The reason we're talking about Social Security timing is the importance of it, and I'm going to talk about why it's so important. If you want to ask us a question, you can ask us a question with the chat feature. It's down at the bottom of your screen, the bubbles with Q&A, and you can just type that in and we'll answer questions at the end. Depending on how many questions we have, we'll probably only answer 2 or 3, and then we'll respond to your questions either on the phone or with an email. And if you have questions after the seminar, of course, you can call us and email us. This thing's going to take, the Social Security part's going to take around 30 minutes. What Jesse's going to talk about Medicare is about 5 minutes. I'm a Social Security, a certified Social Security expert. And so I know a lot about Social Security, and I'm just here to help you and your friends and family to make the best decisions regarding your Social Security. So if you think about the most important, the most valuable assets that you have, that any top three most valuable assets that most Americans have. For most people, it's their, one of them is their 401k, IRA, their retirement plan. Another one would be their home, the equity they have in their home. But one that most people don't think about is the present value of their future Social Security payments. The present value of those payments, clear out to your life expectancy. But it ends up being, for most people, $500,000 to maybe as much or more than $1 million. So we're going to help try to teach you a little bit about how to take your Social Security, and because it's a very important and complex decision. One of the things, and I don't want you to read this slide, of course, but this comes right off of the Social Security Administration website, and it says in the middle of the second paragraph, that is, it says that the Social Security office staff are instructed not to give advice. They're just to answer questions you have and implement your decisions regarding when you claim. So I'm not trying to poo-poo them or anything. But they are government employees, and you're not going to get a lot of help in making your decisions from them. So this is my Social Security statement. We're going to show it on the screen now. Y'all have this. This is from back in 2019. And it shows that at full retirement age, I get $2,442 a month. On the next page, it shows you, on yours too, up at the top for where it says retirement, that at full retirement age, for me, 67, I get the $2,442. If I wait until 70, I get a little over $3,000. And if I take early, I get $1,705. Well, it's quite a bit more complicated than that. For instance, going back to our presentation there, perfect. One thing it has to do with is someone's life expectancy on when you decide, whether it's 62, 63, 66, 67, 70, has to do with your life expectancy. Because if you take early, whatever you take, that's going to continue for the rest of your life. We all know life expectancies have grown. Back when they started Social Security, life expectancy for most Americans was only about mid-60s. But now a married couple age 65 that's healthy, at least one of them has a 45% chance to live to age 90. And so it's very important. One of the things we use in our Social Security analysis with our software is we enter in your life expectancy. Your life expectancy might be the statistical life expectancy, or maybe everybody in your family lives older to be older, or vice versa. So here's how it works, collecting early versus collecting late. This is assuming the full retirement age is 66. At full retirement age, you get 100% of your PIA, your primary insurance amount. When you take early, each month actually, and each year you take early, they dock you. If you take as early as 62, they reduce your Social Security by 25%. If you wait or can wait, every year you wait, they add 8% to it, clear out to age 70. Doesn't help you to wait any longer than that. If you take it age 70, you get 132% of your full retirement age primary insurance amount for the rest of your life. Spousal benefits are a little bit different. The spousal benefits are basically, you know, in our example of age 66 for full retirement age, if you take early, as early as you can, if you take at age 62, your spousal benefits are docked even more, down to 70%. They're docked by 30% down to 70%, and that continues for the rest of your life. But notice at age 66 that from age 66, age 67, 8, 9, it's all the same. It's 100%. So you don't benefit with your spousal benefit by waiting. Now, this comes from Social Security's administration themselves, that 72% of Americans take Social Security early and get a reduced benefit for collecting early. Only 28% take it full retirement age or beyond. I think that obviously some people have to take Social Security early because they have to retire early for health reasons or whatever, but I think probably many of those 72% that are taken early, if they know what it means and what it's going to cost them down the road to take early, they might have thought differently, and that's what we're trying to explain to you here. So drawbacks, some of the drawbacks to collecting early. First off, you get that reduced Social Security benefit. If you take at age 62, you get 75%, and you get that for the rest of your life. Even if you live to 95 or 100, you're at 75% of what you would have gotten if you'd taken it full retirement age. It's also going to apply to your spouse. In my case, I have a higher Social Security benefit by far than my wife. Most of her working days was a stay-at-home mom. That was her job, and didn't pay into Social Security. So when I die, if I die first, because I'm older than her, she's going to get my Social Security. So that's a consideration. Another drawback for two other drawbacks for collecting early, or one is called the earnings test, and the other it has to do with taxation. So we'll talk to you about that. So if you're continuing to work while you're still collecting, let's say you're 62 and you start taking Social Security, but you're still working and you're going to work till you're 66. If you're under your full retirement age, they're going to withhold Social Security benefits from you for everything you make in your job over $19,000 a year. They're going to withhold $1 in benefits for every $2 of earnings above that $19,000 a year. Once you reach the month of full retirement age, they no longer withhold any benefits. So you can see where you could be shooting yourself in the foot applying for Social Security while you're still working. Another issue is taxation. In taxation, it's kind of complicated if Social Security is being taxed. It has to do with your provisional income. And as you can see in the bottom of the slide here, it shows what provisional income is defined as. It's your adjusted gross income off your tax return, plus any tax-free interest, it's included in this, plus half of your Social Security benefits. So if you notice, when we look at for a married couple filing jointly, if that provisional income number is between 32 and 44,000, up to half of their Social Security is taxed. If it's over 44,000, up to 85% of their Social Security is taxed. So let's talk about some potential unnecessary causes of taxation of Social Security. Obviously, if you're working, you have that salary, and that's going to affect your adjusted gross income. But let's look at investments. For instance, CDs. If you have a CD at the bank or some CDs at the bank, and they're gaining interest, and you're just letting them grow, you don't need the income, you're just letting them grow. The bank is still sending you a 1099 after the end of the year, telling you how much interest you earned and telling the IRS, and that's going to affect your adjusted gross income and increase the possibility of taxing your Social Security. There's two other things: dividend income and capital gains income, capital gains distributions. More often than not, this comes from stocks or mostly mutual funds that you have in non-IRA accounts. And the mutual fund family or company is going to send you a 1099 in early February probably that says how much your dividend income and capital gains distributions. Even though you're just letting your mutual fund grow, you're still responsible for those dividends and capital gains distributions within the mutual fund. Capital gains distributions occur when the fund manager sells a stock for a profit. Even though you're not getting they're not sending you the money, they're reinvesting it, you're still responsible, and that can cause your Social Security to be taxed. And finally, tax-free bonds, tax-free income will cause your Social Security to be taxed. Now, the other, the one thing I want to point out that I always remember when I think about taxation of investments is that a famous rich guy named Rockefeller once said, it doesn't make sense to pay taxes on income you're not receiving. It doesn't make sense to pay taxes on income you're not receiving. So the forms of taxable investments that I just described, CDs, mutual funds and stocks that are paying dividends and capital gains and tax-free interest, those are things that might be able to be tweaked a little bit to defer the taxes and not have that income affect your Social Security taxation. So let's look at for most people's sources of retirement income and what percent of that income is taxable. Of course, many people take withdrawals from their 401k and IRAs in retirement to supplement their Social Security. 100% of that is taxable. If you have a pension, 100% of that pension is taxable. But your Social Security, the most that is going to be taxable is 85%. So it's taxable anywhere from 0 to 85%. And so if we want to maximize one of those three sources, probably I would expect that you would want to maximize the source that is the least taxable, which is Social Security, and that's what we're going to be talking about. So what factors might determine when and how someone should take Social Security? Factors like your age, especially for married couples. If one is, somewhat younger than the other one, that's going to have an effect on when you take Social Security. Each of you's life expectancy and your current health. Your income needs, of course, are going to affect it, and your total investments to take income from. So this is my copy of a Social Security analysis report that we provide for clients. Jesse's going to show you a screen that's got a copy of it on there. And it just says Social Security timing. We did it for a hypothetical people named Herbie and Henrietta Husker that we're going to talk about in a little bit. Put in different kind of assumptions that we put in there. And then what it does, one of the things it does, it's a 15-page report, is it compares if Herbie and Henrietta Husker take early, take right away at age 62, versus in their case, if they take this suggested strategy. And the suggested strategy for them has to do with their life expectancies, as you'll see in a little bit. But there's a substantial difference in the expected lifetime benefit. It's based on present value of those future Social Security dollars. It's a difference for them of $56,000 in today's money. Also, another thing the Social Security report shows is it shows this graph. Along this are the different years and how much Social Security they get. Right here is where they're saying that the husband's going to pass away and the wife is only going to get his Social Security. But the green line up here is their income need. And as you can see, the income need is greater than what their Social Security payment is. And we call that the gap. And that's part of this retirement income planning, is to figure out have me help you figure out how to fill that gap with income from your investments or whatnot. So let's meet Herbie and Henrietta Husker. They're not retired yet, married. Herbie was the high wage earner in their family. She stayed home and took care of the kids. Probably worked harder than him taking care of the kids, but she didn't pay into Social Security, so her Social Security benefit at full retirement age is lower. Both of them, the full retirement age is 66. So this is the kind of, this is just an example of the present value dollars calculation of Herbie and Henrietta Husker taking the earliest they can at age 62. Notice their primary insurance amounts, $2,200 for Herbie, $600 for Henrietta. That occurs at age 66. But if they take early, they get a reduced amount, reduced by 75%. So Herbie's $2,200 becomes $1,650 and so on. She's also going to take her benefits and spousal benefits starting at age 62. Down here along the bottom, it shows all those benefits and a total present value dollars for Herbie and Henrietta if they take it 62 and live through their life expectancies. And by the way, notice the life expectancy of Herbie is only 75 and Henrietta is 82. And so he's going to pass away at 75 and she's going to get survivor benefits. But anyway, the total present value dollars of this choice is $550,000. So if we have them both collect at age 66, they get their full benefits, spousal and individual benefits, and the total present value dollars of that choice is $580,000. Notice it's $30,000 more than if they took at age 62. It continues to get more complicated. Let's see what they do, Jesse, if we go to age 70. Now, age 70, notice the total present value dollars of their Social Security income is $532. Wait a minute. Why is that less than $580,000? Well, the reason is because Herbie died at age 75 in our planning in this example. So they would have been better off taking it age 66 than both waiting until age 70. But one of the things that our computer software program that I use figures out is all of the different strategies. Every different strategy you possibly could take between now and age 70 for not only collecting your benefit, but collecting spousal benefits. And so what does the computer tell them, Jesse, if we collect Social Security at the time and the age that's maximum for them? So it's the next slide. So the computer generated maximum Social Security strategy for Herbie and Henrietta, given that he's going to live to 75, she's going to live to 82. It has him collecting at full retirement age of 66 because he's only going to live till 75, her collecting at age 62, and then waiting until 66 to collect her spousal benefits. That strategy results in a $584,400 present value of that future income stream. So that's how they maximize their Social Security. But the big question is, what if they live longer? And we can do this and run different what if scenarios. You know, maybe Herbie came in and told me that nobody in his family lives past 75, and he's, you know, got some heart issues or has had cancer or something like that, and so 75 is right. But on the other hand, you know, maybe everybody's healthy in his family, and he's healthy as a horse, and so is Henrietta, and all their parents and grandparents live to a ripe old age. Then we would want to change the inputs into the software and see what happens then. And so here it is. Okay, so using that same strategy that I just showed earlier, with Herbie collecting at 62 and her collecting early and then not taking the spousal benefit until 66, that strategy, if they live to age 85 for Herbie and 92 for Henrietta, results in a $962,000 present value Social Security benefit for Herbie and Henrietta. But wait a minute, that's not as good as if they both waited to age 70. So that's why we have to, you know, the computer figures this stuff out for us using life expectancies and everything on how to maximize Social Security. And it's way too complicated to try to do by hand or just try to guess. So what we do is we help our clients try to plan for the retirement income. You can't plan everything because there's all kinds of different things that can happen in the future. But one of the things we focus on is planning on maximizing, given your circumstances, your Social Security benefit for you, because that's taxed the least, no matter what. Even if it's 85% of it is taxed, it's taxed less than your IRA or less than your pension. And then we try to fill the gap with your income from your investments, from maximizing your investments. I'm going to show you a little bit about how we do that briefly. That's not it. There you go. There you go. Thank you. So this is Herbie and Henrietta Husker, and one of with one of the tools that I use, the number up in the upper left-hand corner that says risk, that's their risk number. It's the number between 0 and 100, 100 being totally wild, can tolerate any kind of risk, 0 being a totally risk-averse person. We went through a questionnaire with Herbie and Henrietta, and these were actual people, I just changed their names. We went through a questionnaire and found that their risk number was 56. I then analyzed their current portfolio. Where's my mouse? There it is. Their current portfolio, which, and the combination, the recipe of their investments together comes up to a risk number of 67. Notice, if you can see this in the small print, it says potential annual return 6.08%. I then made my own recipe of investments, putting an investment portfolio together for a proposal to Herbie and Henrietta that matched their risk number or their risk tolerance of 56, and with different investments with actually less risk than what they're taking right now, we come up with a potential annual return of 9.76% versus only 6% with what they're doing. And then what we do is we use this thing called a retirement map to analyze their income. Now, this is their current portfolio, risk number 67. Starting out with, they had $500,000 in investments. They're not retired yet. They're going to retire in 4 years in 2025, still saving $800 a month. When they retire, they're going to take $4,000 a month out. Okay. So the red line is the expected growth of their account and with the expected projected returns, and going downhill, as you can see, as they're taking withdrawals. And this is all in the red, and that's not good. The shaded area is the standard deviation of what it could be above or below what the projected amounts are. But this shows us that they have a 31% probability of not running out of money before they run out of air at age 90, and that's not good. So the next slide shows us the proposed portfolio. And let's go back to the previous slide, by the way. So notice these numbers over here are a different scale. $1 million's clear up here on the current portfolio. On the proposed portfolio that Jesse's going to show you, $1 million is here. I just wanted to point that out because they look a little bit different. Again, same deal, starting out with the same amount of money, saving the same amount of money, taking the same amount of money out, $4,000 a month in retirement, but we're in the green. Green is good. Notice the line of their projected return and account value is sloping up even after they start taking money, and the shaded areas of standard deviation above or below what it's expected to do stretch out much further. They have a 91% probability of reaching age 90 without running out of money, and that's good. And so that's what I do, is try to help people plan their retirement income safely. A large part of this is this important and complex decision regarding Social Security, and we'll provide this Social Security analysis report to anybody just to try to help them to make the best decisions regarding their retirement income planning. Now I'm going to turn over to Jesse, and Jesse's going to talk to you briefly about Medicare.
I am going to make this quick and just touch on pretty much the very, very basic things about Medicare, since we don't have that much time. I've been doing Medicare insurance for about 6 years, I think. So if you have any other questions on this, or you ever want to talk about this, give me a call and I'll be happy to help you, since we have to kind of do a very brief overview on all of this stuff today. Okay. So there's several parts of Medicare that can be very confusing. The main parts of original Medicare are parts A and B. And part A is going to be your hospital coverage. So that's anything having to do with the hospital if you had to go stay at a hospital. Part B is going to be your medical insurance, and that's going to be anything having to do with doctors. Even if you're in the hospital, if a doctor's coming to do anything for you, that's going to fall under Medicare Part B. And Part D is probably the easiest part to remember because that's your drug coverage. And that's a separate plan that's offered through offered through insurance providers. And that's going to cover all of your prescription medications. So the costs of each, the cost of Part A, you're going to have a $0 premium for Part A as long as you've been paying into Social Security for at least 10 years. You have a deductible and co-pays that you're responsible for. The deductible this year is $1,484. So if you get hospitalized, that's what you have to pay first before they cover anything. And then you'll be also responsible for co-pays if you're in the hospital for longer than 60 days. The second thing is Part B costs. So this is your medical insurance costs. The monthly premium for Part B this year is $148.50. That's something that changes every year, but it typically only changes by just a few dollars. You are responsible for a deductible and coinsurance. The deductible for this year is $203. The coinsurance that you have to pay for any care that you get after you pay that $203 is 20%, but there's no cap on that. So if you had, say, something big happen to you that was a $100,000 bill, you would be responsible for $20,000 of it. For Part D, the premiums this year for those range between $7.30 to $104.70 a month. You also have deductibles and copays based on your plan that you go with, and also based on your specific medications. Usually the deductibles this year are from $0 to $445, and that always they change every year, and it will always depend on what medications that you have. So to ensure your share of Medicare costs, your share is going to be your Part A, that hospital deductible, and the co-pays that you would be responsible for if you have to be hospitalized for longer than 60 days. You're also responsible for your Part B deductible, which is just about $200, but then you're also responsible for the 20% coinsurance that has no cap on it. And then also drug costs can be really expensive if you don't have a Part D plan. So the way that you can protect yourself and insure against those costs that you're responsible for, you have two options. The first option is a Medicare supplement policy. And so you would get your Part A hospital insurance, your Part B medical insurance, your Part D through Medicare, and then you would also purchase a Medicare supplement plan through an independent insurer that would cover all those gaps that we just talked about. Basically, a Medicare supplement plan, depending on which plan you choose, will cover all of that stuff that you would be responsible for. So all you'd end up paying is your Medicare supplement premium and your Part B premium and your Part D costs, but everything else would be taken care of. So that's a more front-end loaded option. So your premium costs are going to be higher, but the costs that you incur when you actually have to get care are going to be much, much lower, and you're going to know exactly what they are ahead of time. The second option is Part C, which is a little confusing, but that means Medicare Advantage. For a Medicare Advantage program, basically you are paying a private insurance company for all of your Medicare. So you are not getting your Medicare through Medicare. You're getting it through the insurance company. So you're not paying your Part B to Medicare. You're paying everything to the insurance company. And they're going to wrap up all of those parts into one plan. And the plans just depend on the insurance company. They're all different. They all have the different deductibles, coinsurance amounts, out-of-pocket maximums, all those types of things. It's going to be a lot more similar to what you probably already have through like your work insurance plan or through a personal insurance plan than what we've just talked about with what Medicare actually covers. This is more back-end loaded, so the premiums on this are going to be lower, but when you actually go to get care, you're going to be paying a lot more, and the costs are not as much straightforward as they would be if you had a Medicare supplement policy. Another thing to take into account with those is that you have to go to whatever network the Medicare Advantage plan tells you to go to. If you have a Medicare supplement policy, you can go anywhere in the entire country, and it's all going to cover you exactly the same as long as they take Medicare, but you are subject to the Medicare Advantage plan's list of doctors if you're under that plan. So when to sign up, I'm not going to read this entire slide, but I can send it to you if you want. The very basics of when you need to sign up is no matter what, you're going to sign up for Part A when you turn 65. If you are taking Social Security by the time you turn 65, you're going to automatically be enrolled and you don't need to do anything. But if you're not taking Social Security, you need to enroll with the Social Security office before you turn 65 in order to get Part A. Part B, Part D, and a Medicare supplement or Medicare Advantage plan is a little bit different. You can enroll when you turn 65 or when you retire, and you'll want to do whichever one is later. So if you're still working when you turn 65, you can delay getting Part B, Part D, and your Medicare supplement plan, and you can stay on your work insurance until you retire. And so then you'll just want to reach out and make sure that you sign up for those things so that they're effective the month that you retire and your work insurance ends. So like I said, if you have any questions about any of that or want me to send any more information to anybody, I surely can. Just reach out to me.
Do we have any questions on the Q&A thing there, Jesse? Doesn't look like it.
I don't see that we do.
Looks like we're all right. If, as you've watched this this afternoon, if you start thinking about some questions, you can call the office at 421-2626 or email Jesse or I at bob@bobbenny.com or jesse@bobbenny.com, and we'll be sure to get back to you. We'd love to hear your feedback. If the information was helpful to you or not helpful or anything you would change, any kind of constructive criticism, we'd welcome to, because we're going to keep doing these webinars on different topics. And keep in mind that it's really important to have this Social Security analysis done before you retire and start collecting Social Security or before you collect Social Security, so that you have all the information that you need. And so offer it to your friends and family. It's something that we give for free. We just want to help them and help you. Our next webinar is just going to be 2 weeks from today on July the 8th at noon, and we're going to be talking about inflation. What's causing inflation, the threat of inflation facing our country and our economy, and how to protect yourself from the effects of inflation financially. But we thank you so much for coming and joining our webinar today, and hope you have a great day. Thanks.